Your bank has a secret menu, and you're not on it. Ever notice how millionaires get free everything while you're paying $35 because your paycheck hit 2 hours late? That's not a coincidence. That's the business model. Today, I'm breaking down the three net worth levels where banks completely change how they treat you, the math behind each tier, and why the system is designed to keep you exactly where you are. Let's get into it. So here's something banks will never tell you in their commercials. 80% of their overdraft fee revenue comes from just 9% of customers. 9%. That's not a service. That's a targeted extraction operation. Banks collected $12.1 billion in overdraft fees in 2024 alone. Billion with a B. And that money came almost entirely from people who could least afford it. Meanwhile, if you have $1 million, you get a personal banker, zero fees, and they'll let you borrow money at 4% interest to buy a yacht. Same bank, same building. Completely different experience. Let me walk you through the three tiers. Tier 1, under $30,000 net worth. I call this the struggle tier. This is where banks make the most money per customer. And if that sounds backwards, that's because it is. It's also completely intentional. The median transaction that triggers an overdraft fee is $24. $24. You bought lunch and your paycheck hadn't cleared yet. The fee? $27.08 on average. You paid more in fees than you spent on the actual purchase. And here's the math that should make you angry. A 3-day overdraft on that $24 purchase works out to an effective APR of over 16,000%. That's not a typo. 16,000%. Loan sharks are looking at banks like, dang, that's aggressive. 34% of households earning under $65,000 got hit with overdraft fees last year. For households earning over $175,000, 10%. The less you have, the more you pay. That's the system working as designed. But overdrafts are just the appetizer. Let's talk about the predatory product buffet that targets this tier. Payday loans. These are marketed as quick cash for emergencies. What they actually are is financial quicksand. The average payday loan APR is 391 to 400%. A $375 loan typically costs over $520 in fees, and only 14% of borrowers can actually afford to repay on time. So what happens? They roll the loan over, and over, and over. 1 in 4 payday loans gets rolled over 9 or more times. That $500 emergency loan, it becomes $2,000 in debt within months. Auto loans in this tier are brutal too. If your credit score is below 600, you're looking at 15 to 21% APR on used cars. Someone with good credit pays 5 to 7%. On a $30,000 car loan, that's the difference between about $4,000 in total interest and nearly $13,000. That's a $9,000 penalty for being poor. And let's not forget store credit cards. Want to save 15% today? Sure, and the APR is 30.14%. 90% of store cards have maximum rates above 30%. And those deferred interest promotions? Miss one payment and they charge you retroactive interest on the entire original balance. Surprise! The compounding damage is generational. Being unbanked costs roughly $3,000 a year in check cashing fees, prepaid card fees, and money orders. Over 30 years, that's $90,000 in direct costs and about $300,000 in lost wealth if that money had been invested instead. You're paying a poverty tax to access your own money. Tier 2, $30,000 to $1 million net worth. I call this the middle class upgrade. But don't get too excited. This is where banks start being slightly less hostile. You get access to tiered premium programs with names like Preferred Rewards and Priority Banking. They sound fancy. Let's look at what they actually deliver. Bank of America's Preferred Rewards program starts at $20,000 in combined balances. That gets you gold status. What does gold status give you? A 25% bonus on credit card rewards and a $200 reduction on mortgage fees. So if you were earning 1.5% cash back, now you're earning 1.875%. Revolutionary. At $50,000, you hit Platinum, 50% rewards bonus. At $100,000, Platinum Honors gives you 75% boost. Now that 1.5% card becomes 2.625%. That's actually meaningful if you spend a lot. Chase Private Client kicks in at $150,000 in combined balances. You get a dedicated banker, free ATMs worldwide, and a 0.25% discount on auto loans. Citigold requires $200,000 and adds a wealth advisor and museum passes. Wells Fargo Premier wants $250,000 for relationship mortgage pricing. Here's the catch nobody talks about. Keeping $50,000 at Bank of America's 0.01% APY instead of a high-yield savings account at 4% means you're losing about $2,000 a year in interest. That often exceeds the value of the rewards bonuses. You're paying for the privilege of being a preferred customer. And credit card rewards? They're literally a wealth transfer mechanism. Federal Reserve research found that rewards programs move $15.1 billion annually from low credit score consumers to high credit score consumers. People with scores above 780 earn $9.50 per card and save $7.10 in interest. People with subprime scores earn $1.80 but pay $6.40 more in interest. The rewards game is rigged. The house always wins. And in this case, the house is Chase. Mortgage Access shows similar patterns. Overall approval rate is 81%, but Black applicants face 21% denial rates. Hispanic applicants, 17%. White applicants, 11%. Same income, different outcomes. The relationship discounts that actually matter, like 0.125 to 0.375% off HELOC rates, require maintaining $20,000 to $100,000 in balances. Most Americans can't access meaningful rate advantages because they can't afford to park that much cash earning nothing. Tier 3. Over $1 million net worth. Welcome to the VIP Club. This is where banking becomes an entirely different sport. At $1 million, Citigold Private Client gives you a dedicated wealth management team, a World Elite MasterCard debit with hotel upgrades and concierge services, and $400 in annual subscription rebates. Nice perks. But true private banking? That's a different universe entirely. JP Morgan Private Bank requires $10 million minimum. Goldman Sachs Private Wealth, $10 million. Morgan Stanley Private Wealth, $5 million. Bank of America Private Bank, $10 million. At these levels, you get something the rest of us don't even know exists: securities-based lending. This is borrowing against your investment portfolio without selling anything. You don't trigger capital gains taxes. You don't lose your positions. You just use your wealth as collateral and get cash at rates of 4 to 6%. The total market for these loans is $138 billion. Meanwhile, regular people are paying 9 to 11% on personal loans and 12 to 16% on credit cards. The wealthy borrow at half the rate or less. This enables what financial advisors call the buy, borrow, die strategy. And yes, that's its actual name. Here's how it works. Step 1. Buy appreciating assets, stocks, real estate, whatever. You don't pay taxes until you sell. Step 2. Borrow against those assets at 4 to 6% interest. Borrowed money isn't income, so no taxes. Step 3. Die. Your heirs receive a stepped-up basis, meaning all the capital gains accumulated during your lifetime are erased. They inherit the assets at current value and can sell immediately with zero capital gains taxes. You lived off borrowed money, never sold anything, never paid taxes, and your kids inherit everything tax-free. That's not a loophole. That's the system working exactly as designed for people who can afford tax attorneys. And then there's investment access. To become an SEC-accredited investor and access hedge funds, private equity, and pre-IPO deals, you need $1 million in net worth or $200,000 in annual income. Only 14.8% of American households qualify, but they control 78.7% of all private wealth. Hedge fund minimums range from $100,000 to $10 million. Private equity minimums go from $250,000 to $25 million. The average company now stays private for 10.7 years before going public, compared to 6.9 years in the 2000s. That means most of the value creation happens in markets closed to regular investors. By the time you can buy the stock, the big gains are already captured. The wealthy don't just get better service, they get access to entirely different financial instruments. Now let's talk about who ends up in each tier. Because it's not random. The racial wealth gap determines banking tier placement for most Americans. The median net worth for white families is $285,000. For Asian families, $536,000. For Hispanic families, $61,600. For Black families, $44,900. That means the median Black household has 15% of the wealth of the median white household. 15%. This maps directly onto banking access. About 20% of white households have reached millionaire status and can access private banking. For Black households, 5%. At the other end, 10.6% of Black households remain completely unbanked, compared to 1.9% of white households. That's a factor of 5.6 times. And here's what's frustrating. Between 2019 and 2022, Black median wealth rose 61%. White median wealth rose 31%. Sounds like progress, right? But because the starting points were so different, the dollar gap actually increased by $50,000. The ratio improved. The actual disparity got worse. White families now hold 84% of total U.S. household wealth, while comprising 66% of households. Black families hold 3.4% of wealth, while comprising 11.4% of households. The tiers aren't just about money. They're about who gets to build wealth and who gets wealth extracted. Let me show you the lifetime math, because this is where it gets really dark. Take two people with identical $50,000 incomes. One has a $20,000 savings cushion and a 750 credit score. One lives paycheck to paycheck with a 620 score. The person without the cushion pays annually $210 in overdraft fees, $144 in monthly maintenance fees, $1,500 extra on auto loans, $120 extra on credit card interest, $60 in out-of-network ATM fees. Total, over $2,300 a year, for being in the same financial position they were last year. Over 30 years, that's $70,000 in direct costs and approximately $200,000 in lost opportunity if that money had been invested. That's a $270,000 lifetime disadvantage. Same income, different tier. The person with the cushion builds credit, qualifies for rewards cards, eventually reaches premium banking tiers with fee waivers and rate discounts. The person without pays fees that prevent building the cushion needed to escape. It's a trap designed as a service. The $12.1 billion extracted annually in overdraft fees funds the quote-unquote free checking accounts enjoyed by wealthy customers. You're subsidizing their banking experience with your late paycheck penalties. So what do you actually do about this? First, know the thresholds. $150,000 gets you Chase Private Client. $100,000 gets you Bank of America Platinum Honors. These are real benefits if you can reach them without sacrificing better returns elsewhere. Do the math on whether parking cash for perks beats high-yield savings. Second, credit unions exist. They're member-owned, non-profit, and typically charge lower fees and offer better rates. They're not perfect, but they're not designed to extract maximum revenue from their most vulnerable customers either. Third, never use payday loans. Ever. 400% APR is not a solution to any problem. If you're in that situation, literally anything else is better. Borrow from family. Sell something. Negotiate with whoever you owe money to. The payday loan industry exists to trap you. Fourth, build the cushion. Even $1,000 changes your relationship with banking. It's the difference between paying overdraft fees and not. It's the difference between needing payday loans and not. The system penalizes you for not having a cushion, which makes building a cushion harder, which is the point. Fifth, check your rates on everything. Credit cards, auto loans, mortgages. If you've improved your credit score or net worth, you might qualify for refinancing that actually saves money. Banks won't call you to offer better rates. You have to ask. The banking system has 3 tiers because that's how they maximize profit. The struggle tier pays fees. The middle tier thinks they're getting deals while subsidizing the VIP tier. And the VIP tier gets the actual deals, pays the least, and passes wealth to the next generation tax-free. Once you see the tiers, you can't unsee them. And once you understand the math, you can start making moves to change which tier you're in. If this video showed you something you didn't know, hit subscribe. I break down how money really works, who the system is designed for, and how to build wealth despite it. Drop your net worth tier in the comments. Let's compare notes. I'll see you in the next one.